Hi, welcome to Smart Investor. Today, we are going to learn an interesting topic that we are already doing on a strategy, that is calendar ratio spread. Last month, in month of September, most of us who are doing this strategy got losses. So I also got a loss around 28,000 per set. Another set I got 30,000. Together, I got loss around 60K. This strategy, though it has been giving very good profits every month, but this month we encountered some losses. So after that, I try to understand this scenario, where exactly we can fix the problem, because market has rallied from 19,200 all the way to 20,200. 1,000 points rally, and from there again it took U-turn and came down all the way to 19,500 almost. So 1,000 point up, 500 points down, 700 points down almost. Together 1,700 points swing has really hurt this strategy. So we ended up with some losses. But even this scenario also, there are ways, some adjustments we can make to avoid losses. If possible, we can turn it to good profit also. So we are getting to a simulator, stock market simulator. We'll understand. I will keep my strategy there, what I have taken, and how these adjustments avoid these losses and convert it into good profit. There are basically 3 steps we need to adapt. First, one step is that first we need to add hedge. When spot comes to sold option, strike would be BP strike. Now, point number 1. Point number 2 is that we have to roll up the tested side calendar spread, which means when spot is moving to BEP, so break-even point is right, upper side break-even or downside, lower side break-even, either side. If spot is coming to break-even point, we will have to roll up tested side call, if it call side, call calendar spread, or put side, put calendar ratio spread, either side, 200 points above, right? So I would explain all those things, how I rolled up 200 points whenever scenario happen, a spot comes to break-even point. Third step is that if at all after these 2 adjustments, market is coming back a reversal, takes reversal, then we'll have to watch out carefully hedges. And if hedge comes to, any of the hedge comes to cost price, we need to close one by one. We'll have 2 hedges, right, by this time. So after 2 adjustment, we'll have 2 hedges. And other adjustments are already discussed in the previous videos, that dedicated video is there. Please watch the video. Very simple. Just with the spot, we'll keep rolling put side. Market is moving up, and market is coming down. We'll keep rolling down call side. So always we'll have to keep initially spot to sell option 400 points. If it comes to mid of the week, 300 points, and final week of the expiry will come distance around 200 points. Like that, we'll keep rolling put side or call side based on the market direction. This is the major adjustment you will have to do that. But this strategy, how I turned it to profitable on the simulator, I will show you these 3 adjustments. I'll repeat these 3 adjustments. Number 1, add edge when spot comes to sold option, and second one is roll up when spot moves to break-even point, reaching to break-even point, roll up 200 points. And third one is market takes U-turn or reversal, will exit hedges one by one when it comes to the cost price. Otherwise, the market continue to go up, no worries, because we will be having 2 hedges, which is fully protected. Upside is fully protected with the 2 hedges. We'll keep rolling up put, so to collect additional premium, so that this strategy would be end up with no loss or minor profit. The upside will not be having any problem when we have 2 hedges and market is moving upside. Let's get into the simulator live session. We'll understand much more better way what I have explained these rules for your convenience. Thank you for watching. Please do subscribe and like the button if you like this video, if it is useful to you. Now we are on to stock market simulator. This is similar. So the trade what I have taken for the September is series I took on the August 28th. I entered this trade on August 28th. Let's go to Nifty on 28th. Let's say start of the day or end of the day, whichever is comfortable we can take. Option chain monthly series September 28th. Strikes what I have taken is 18,800. 18,800 is the one I took the trade. So sell, and 19,800, which is 1,000 points distance from the put sell and call sell side. Both the sell distance between both the sold options is 1,000 points. So to hedge this, we'll take half of the quantity, one strike above the sold strike from the next month, that is October. So now we'll take 19,900 buy, and put side is 18,700. So lot size will adjust. Sold option I took 10 lots, and bought option is half of the sold option quantity, which means 5 lots. 5 lots. Now this is the structure that we took the trade. Okay. Now see, if you observe this, max profit is 65,000 around, and estimated margin in the beginning is around 8 lakh. This is the basic thing. And break even, remember, 18,652 around 19,975. So close to 20,000 break even. Okay. So these are the break even and estimated margin, max profit, all the things. And when I enter the thing, almost we entered in spot was 19,250, 300 around. So currently spot is 19,300. Right. So now this is the setup. We entered this setup, and we'll move on to one by one and observe this one. Okay. So now we'll move on. Next, we'll move to next day, 29th August. No change is required. 30th August, no change. 31st August, no change. MTM profit is 5,000 now. 1st September on Friday, 10,000 profit, no change, because this is in the green line zone, so we don't need to worry about that. And 4th September, it is still profitable, 8,900. We'll see any sold option is coming close to 20 rupees. We'll have to observe this one. As of now, no. So still we have some decay is there. Then so we'll move on that. This is now we arrive to 5th September. We arrive to 5th September. 23 is the premium. We'll see if we get a less, it becomes less, then it's 22.5. So now this is the time to exit this premium and roll up to next level. So we'll close 18,000. We are closing. See, we are closing this 18,800 put. Maybe then I'll show you which strike is the best to choose. We'll close means say this is the exit. 22.4 we exited put, and we'll see which is a good value. Right, initially we'll have to maintain 400 points from the spot. Remember, spot is, where is the spot? Spot is 19,500, 600 around that level. So we'll see whether 200 is getting a good premium. Yeah, 19,200. Yes, 19,200. Right, so close to 600. So we'll keep the distance 400 points. So we'll sell 19,200 put. 19,200 is, yeah, 10 lots. This is, we'll keep it in 10 lots. We'll keep them sold one. So if you see here, this is, we rolled up 18,800 put to 19,200. Maybe, yeah, one can roll up to 19,000 also. But this, because market appeared very strong, for a safer side, we'll just go slightly closer to the spot. We'll move on that, right? Now, we'll move on to next day. End of the day, what happens, we see, yeah, good. So end of the day, it has come down to, come up close to 90,600. So, okay, fine. Now we'll move on. Next day, yeah, no change. Yeah, no change, no change is required. 6th September and 7th September, we are in profit and no change is required. And 8th September, 8th September, see, spot is coming close to this point, 19,800. Why we need to find? So we set a rules, right? When spot comes to sold option, what is the sold option? Call side, right? It is going to a call side, that is 19,800. As for the rule number 1, just redefine rules, right? Advanced rules. As per that, rule number 1 is spot comes to 19,800. That is the time we'll have to add hedge, right? So what is the hedge? Hedge, you need to figure out what is the break even, upper break even point. Upper break even is 20,000. So we'll enter 20,000. So, but we'll see less, -5 points, because whenever spot comes to 19,800, maybe we'll take this this hedge. That's it. Just I'm trying to keep it 19,800. That's okay. Either case, we'll take it. So spot is around 19,800. So we'll add hedge from the next series, that is October, of break even is 20,000. We'll have to choose the strike of break even, upper break even, tested side break even, that is 20,000. So what is the 20,000? 261 by 20,261. Yeah, we bought 20,000 call at 261.5. Now upside is completely hedge. Though it is showing red, this is okay. It is manageable because now we have 2 hedges. Market, if continues to move higher, we'll keep getting the premium from the sold puts. That is the plan. Now let's move on. We added hedge. Let's go to end of the day. How is the end of the day? Yeah, end of the day is just spot is 820 on 8th of September. This change we have done on 8th September. Now let's move on. Next day, I mean, it's a Friday. On Monday, what happens? We see. Oh, on Monday, let's see what has happened. So comes back just 5 minutes. So let's keep it 19,000 on. Oh, what happened? We'll go to 11. Yeah, 11th is 920, right? 920. We'll see spot is around 19,900. That is okay. 19,900. We'll see how is that. Now, as of now, any puts we need to roll up. Let's observe. Puts, sold put is 19,000. 200 is, yeah, it is 23. We will see almost close to 20 rupees. We'll see that either we need to roll up. And the other point is, first point is add edge. Second point is, if spot comes to upper break even, what we need to suppose to do that? We have to roll up call side, entire call spread. We need to roll up another 200 points. Remember this point. So we'll see if it spot comes to that level, then we'll see. Let's go to end of the day. Yes, we'll see. Yeah, we'll see this here. What has happened? Spot has reached to 920,000. So as per this rule number 2, spot comes to break even, we need to roll up call side. So what we are supposed to do that? We have to roll up call side. What is the call side we have? So call side is 19,800 one and 19,900. These two will close it. Of course, yeah, there is a loss together. We will book loss. So 1,23,850 from sold call, and profit is 68,650 from the bought. So together, maybe we'll lose around 50,000. That is okay. But you see, because we already got some profit from additional hedge we bought here, right? 20,000. How much we are getting? Almost we are getting 25,000. So here is not a point of calculating profit and loss. We'll have to manage the strategy effectively. Profit and loss is observed. Profit and loss is around minus 7,000. It's okay. So now we'll have to roll up one by one. Now, so I'll close 19,800 call, close. 19,900 call also will close. So 200 points will roll up, right? 200 points means from the September 20,000 sell and October 20,100 buy. This is the call calendar spread rule, right? This is an actual setup rules. But number of lots, we need to check it out. Number of lots, this lots is 10. Sold lots is always higher, right? This is a 2:1, right? So now, so this is what we added now. What was the thing we added now? 20,000 from September, 20,100 from October. So we added this. Of course, we rolled up and we collected and we booked some loss by rolling up. That is okay. This is on 11th September. Now, so also we observe that what has happened? Put, right? Put has come to 19,200. Put has come down to 23. So this is the time to roll up because we need to collect some premium. We already booked some loss by rolling up. Better to collect some premium by rolling up the put. What is the next put? This close this one. Yeah. Get from the September put 19,200. After that, what is next one? Best one is 19,600. We'll just go 19,600 because we booked some loss to cover that. We'll sell 19,600. 19,600. 10 lots. So now this is the changes we have made on 11th September as per the rules. Observe, remember this, what you have done on 11th until September, what you have done. Number one, we rolled up call spread another 200 points as per the rule. And also we rolled up lower put to 19,200 to 19,600. These two changes we have performed now. Now let's move on to next day. We observe 12th September Okay, no issue. 13 September, yes, turn to profit. Just keep observing this profit and loss. 10,000 profit, turn to 10,000 profit on 14 September. But still, we are in a better position. No action is required. But observe the spot. How spot is moving. You need to observe the spot. Spot is moving to 20,170. Right? Just we'll observe this one. On 18th. So what has happened? On 18th, market took some correction. So this is the time, as per rule number 3, we'll have to exit the hedges at cost. Any hedge comes to at cost, we need to exit. So what we have to do, as of now, it just came down 20,129 on 18th September. So as of now, is there anything will change? No, not required. Just this in green and profit and loss. We are in profitable. We don't need to worry about that. So let's observe this. How is the hedges? Just observe hedge and upper hedge is how is the upper hedge is profitable 20,100 and lower hedge is profitable. So you don't need to worry that. But still, you need to keep an eye when market takes U-turn, how it happens. Now we'll go to next day, 20th. So 19th was a holiday. So 20th. 20th, market opened 19,080. So almost 153 points down. So it was very clear indication that market has taken U-turn or correction mode. So this is where we need to observe what has happened. So now this is 3:24. Time is 3:24 directly. We went there, but we don't wait till another day, right? So we'll check start of the day. Start of the day, we'll check open market 19,980 and hedge is we'll keep an eye on the hedge. So please note this hedge we need to check. First hedge is upper hedges. Any loss is coming, then we'll have to exit. Yeah. So turn loss, right? Observe this loss. It has come to 296 from 298. So time to exit this hedge. That's it. It's 500 loss. Okay, that's okay. Sometimes gap down, right? We'll be having more losses. That is okay. But as of now, we close the upper hedge on 20th of September, right? And not only that, we'll also observe that sold put. Where is the sold put? Sold put is 19,600, right? Since we closed the hedge, we'll also have some premium from downside because if market takes upside, we'll be in loss. We'll be in trouble, like slightly. So if we observe this hedge from the 19,600, see, this is we sold at 48 around 49 rupees, has come down to 22 rupees. So time to exit this one. We don't know whether its market takes complete U-turn, but for safer side, we'll exit 19,600 put to maybe 19,800. Let's see. Close 19,600 and go to check 19,800. Yeah, 42, which is fine. Don't go far. Very close, right? Should not go very close. 19,800 10 lots. Okay. Now observe the one chain here. if you observe this, sold call, nearest sold call is 20,000, and sold put is 19,800. And also observe how is the call side. Call side is we are still having profit, no worries. So after this, we'll still move end of the day. So good. See, observe this P&L. This is still we are in good profit. 2.2%. It's showing good profit, but still we will see. This is on 20th. Now move on to next day, 21st. 21st end of the day we have reached, but what is the hedge here? Market still right. Market is in loss. Market is red. So what do we do? Market opened 840. So we'll have to keep an eye on second hedge. What is the second hedge here? 20,000. 20,000 is 188. We don't wait 188, right? Let's go start of the day. From there we'll watch, because we will not wait until that premium is becoming premium is gone. So now see this 920, let's say another 5 minutes, maybe 926, whatever, right? So this a second hedge started bleeding. Now what to do? We will have to exit this from hedge also, as per the rule, right? Rule number 3. As per the rule number 3, we'll have to close hedge just one by one if they come to the cost price. Maybe some loss. We don't know, but we'll have to close as soon as possible. Close this 20,000 hedge. Close it. Okay. And also watch this break even. So lower side break even is 19,600. Upper side is we have very good break even 20,171. Right. So now we'll have to understand. So we remove the second hedge also. So upside we do not have any more hedges. Right. Now the market is, where is the market? Market is, observe this, market is 19,800. 19,800. What is the sold put? What is the sold put? Also 19,800. As per the rule number 1, whenever market spot comes to sold option, either call or put, what to do? We'll have to take hedge. So now this time market took U-turn and reached close to 19,800. So what is the action? We'll have to buy the hedge. What is the hedge you need to buy? Based on the break even. What is the break even downside? Break even downside is 19,600. So we'll have to buy hedge 19,600 hedge from the October series. Around cost of around 122. Okay. So now we bought hedge for 19,600 for 122 rupees. So what we have done now, we have closed the final second hedge, and also since spot reached to sold option of 19,800 put, we bought hedge for downside. Now downside is 50% hedge protection. Of course, far hedge is also there. Where is that? Far OTM hedge is also there, 18,700. But that is not that. That is again still another more than 1,000 points away. But literally speaking, downside is fully protected now. So what we'll do? We'll move on. 2 hours. So, but check it out. Profit and loss. Right? Profit and loss is still are in green. Right? So that is the one we need to observe that. Okay, 19,770 is still going down. Let's go end of the day. 746. That's okay. Now move on to the next day. Friday, 22nd. 22nd. Yeah. 22nd. What do you, any changes? So profit and loss is green, and but market has slightly is there more or less same, but we are reaching to last week of the expiry. So let's observe how is the sold call. How is the sold call? As of now, we sold call. What we have sold call 20,000, right? 20,000 is the one we sold a call. Let's see, 20,000 call has come down to 12 rupees. So this is not good to hold anymore. Close this one, roll down. Close this one, yes. And what is the max we need to close? Maybe we already have a 90,800 put, but we'll have to come down to 19,800 call. 19,800 call from the September series. Yeah, 54. So 10 lots. Yes, 10 lots. Now, so what do we end up now? We have we have now 19,800 sold call and 19,800 put, which means together we call this is a straddle. We have a straddle. We ended up landing on the straddle of 19,800, but downside one hedge, upside we do not have any more hedges. But you see, estimation margin is showing around 13 lakh, which is okay. But this is the time it takes margin because we removed upper hedges, but we'll have only downside hedges. We have two downside hedges. Upside we do not have any more hedges. That's okay. We'll see this. Now, but break even, we'll check it out. Break even is 19,500 to 90,900, around 20,000. We have upside, very good break even. Downside also, we have good break even. What is the spot? 19,680. So now we'll check it out. We'll move on to next 25th Monday. We are in profit. See, keep observing this profit. Right? Just only observe this profit P&L. Now we are close to expiry week of Monday. And then check it out. On Tuesday, 40,000. And Wednesday, 62,000. Wow. So are there any changes we need to make here? 20,000 call, 12 rupees. We don't need to make any changes. We don't need to make any adjustments or roll up, roll down. Just watch on the profit and loss. Watch on the profit and loss. Whenever we see bigger profit, comfortably, we'll have to exit. Whether we hold for Wednesday, those who are having worry to holding this strategy, better exit today itself. Means on Wednesday, just one day before expiry, one can exit. Otherwise, we'll exit on next day. We'll see, because decay will be there. We'll see what happens next day. This one. See, market as a next day means this is end of the day. We'll don't hold this trade till end of the day, right? So we'll go to start of the day, and whenever we see good profit, then we will exit. This is 65,000 started. We'll just keep moving every 50 minutes. Coming close. 946, 10, maybe 10.5, 56, 67, 67, 68,000. Maybe we'll see. Maybe if we hit 70,000 or above, let's wait. Oh, 71,000 profit. Coming close. Oh no. So what we do? We'll close at 71,000. Now it is showing 71,325 at the time of 10:23 on Thursday. On expiry day, same strategy. I booked loss of 28,000 one set. Another set I booked loss of around 32,000. But same set I have taken on the stock market simulator, and I provided all the rules to how to make adjustments. Now it's showing profit of 70, close to 71,000. Now let's close this trade. No more required to hold it, because this is a profit we need to exit. We'll close it. Where we close, yes, exit R. That's all. Yeah. So that's all, guys. So these are the 3 changes I applied to make some better adjustments to come out of with good profit. This is a very good profit. Return is 5.2%, which we have not expected, right? I booked loss of around 2.2%, but after making these adjustments, we got this much return. So what are the 3 adjustments? I repeat. First one is add hedges. Second one is roll up 200 points. Third adjustment is exit the hedges when it comes to cost. All these points I very well explained one by one on the Twitter. Smart Investor publish these points on the group and video. Just watch. If you don't understand this video, please watch it once again and try to understand. Hope this video is useful to you, for you to fine tune this strategy, double diagonal calendar ratio spread. Hope you enjoy, you like it. If you like it, please do like button and subscribe and share it. Thank you for watching. Bye-bye.